Hello, everyone, and thanks for joining us today. I'd like to start by just going through some of our financial highlights from the year, and then we'll dig into some of the operational and strategic updates. Despite the pandemic, we held revenue steady at just over 1% growth for the year, which includes our acquisition of Spire. Our fiscal year 20 was a tale of two halves, and the second half's decline from the pandemic kicked in around April, and we saw the lingering effects of that short-term contraction at the start of our first half of our fiscal year 21. Our adjusted profit was 10.5 million pounds, which included a second half profit of 5.6 million pounds, which really demonstrates the resilience and the agility of our business in responding to the challenges that were introduced at the beginning of the pandemic. With a focus on cash flow, on cost reductions, on efficiencies, we reduced our net debt position from 38.4 million a year ago to 31.6 million at the end of July 31st. And this is a net to debt adjusted EBITDA ratio of 1.8 times. And finally, we are solely focused on the digital transformation market now, and we're reviewing the non-strategic ventures businesses, as we mentioned before. And so as a result, we sold Pragma in August and are in active discussions to sell Hive, a healthcare communications agency. And as such, both businesses have been classified as discontinued operations. So the table at the bottom of the chart here shows our results, including and excluding the two venture disposals for ease of comparison. Now, there are three things that I would like you to walk away with from this presentation as we enter our fiscal year 21. The first is our transformation from a portfolio of agencies to a pure play digital transformation platform is now complete. And we'll talk in more detail about this, but we've launched the integrated kindergarten into the US and Europe, and we've completed the restructuring of all of our legacy businesses. The second is our recovery is on track and it's accelerating. We've been seeing clear signs of recovery since August, and our pipeline is at a 12-month high. Our near-term visibility into the first half is very encouraging, and we are monitoring longer-term effects of the government economic volatility that we're all facing. But the third is that the kindergarten platform is ready for expansion. We've proven our ability to both attract and integrate other fast-growing consultancies, as we have with Spire in Denver, and we have a healthy M&A funnel. Now, before we dive into those topics in more detail, I want to take a couple slides here to just help explain where we play and what we do for people that might be new to our story. Carta is a digital transformation consultancy. We help companies transform their organizations to deliver on the promise that digital brings. It's a $284 billion market, and it's growing at 22.5% per year. This has accelerated from roughly an 18.5% CAGR pre-COVID. So although COVID-19 created a short-term disruption to strategic DX investment, the mid to long-term impact is expected to accelerate spend, because embracing digital is no longer a strategic choice, it's a survival imperative. The other players in the digital transformation space generally break out into the following three categories. The folks on the left are legacy IT service companies. They enable clients with foundational digital technologies, alongside other legacy technology service offerings that they provide, or in some cases, accounting or other types of consulting. The folks on the right are legacy advertising agencies that have digital marketing as a part of their portfolios. Both of these categories have upward potential as digital continues to expand. But the folks in the middle are a new generation of tech consulting providers. They are DX pure plays. They are growing north of 10% organically, and they're currently valued at more than 30 times price to earning multiples. The attributes of these firms that all have in common are at the bottom here in this list. They're pure play DXs, they're platform companies, they're not portfolios, they have strong cloud partnerships, they have a global footprint with a strong US focus, which is a majority of the consulting market globally, and they have nearshore delivery models. And everything we have been doing the last 2 years is to position us in this middle category as we've gone through our own transformation. And we now share these same attributes that you see at the bottom of this slide. Some of you may be skeptical, can we achieve these same growth rates? But I'm not. And here's some evidence of why. When looking at the continuing operations of our core business of Advise, Create, and Connect, it has been achieving double-digit growth rates. And the nucleus of our business, our Create pillar, which is 65% of our net revenue, has been growing at more than 20%. And we expect these trends to continue. This next slide is a list of our core propositions, or what we do for our customers. We help companies create new digitally driven business models. We help them build new products and new services and help them take those to market. We help companies rewrite decades worth of legacy software and move it to the cloud. We help companies implement and utilize advanced data science platforms to help them make better decisions. We help companies respond to the Amazon threat by building their own market-leading e-commerce experiences. And we manage and operate the things that we build for our customers with our digital operations managed services. So that is what our customers buy from us. And we work with some of the largest enterprises in the world on these initiatives, in addition to some well-funded scale-ups. So I'd like to give you a few more details about our progress on the three fronts that we mentioned earlier. Just 2 years ago, our business was a decoupled portfolio of complementary but independent and fragmented digital boutiques. And we are now a tightly connected organization serving the entirety of the C-suite with our three distinct offerings of Advise, Create, and Connect. The newly launched Advise has been a great point of differentiation for our existing customer base and is now part of every proposal for each strategic client. The core Create business, 65% of our net revenue, is recovering extremely quickly from the second half effects of COVID. The restructured Connect was strategically restructured at the half year, and thanks to its mature managed service offering, which we are now expanding to all pillars, it's remained resilient through COVID and is now growing. Our two remaining ventures, Edit and Insight, are restructured, they're right-sized, and they're focused on their core propositions. They are both under strategic review. We've launched our core business in US and Europe, and we have appointed regional leadership teams in both of those regions to lead the entirety of the proposition and the delivery to our clients. We divested Pragma, as I mentioned earlier, and have Hive in a sale process with several credible bidders. On the recovery, we are seeing clear signs of a recovery and appears to be accelerating. We have had several significant Global 2000 wins over the summer, and the pace of new client wins has accelerated, some of which I'll share with you in just a moment. Our partnership channel, which you may recall is something we invested in about a year ago, is starting to fire on all cylinders. With Microsoft and Google recognizing us in their highest partnership tier, the channel has grown over 20% in the past year and has delivered over 24 new clients. Finally, our pipeline. This graph that you see on the bottom right, both weighted and unweighted, is at the highest value in 12 months. And while some of this upswing over the last couple months you see here can be attributed to seasonal client renewals, the value of pipeline in October is higher than it was last October. And that is a very encouraging sign. We have some significant new client wins across all of our strategic sectors, which I'm happy to dive into if there are questions. Finally, our platform is ready for expansion. We've organized the shared services that we've created over the last 2 years across sales and strategy and IT and legal and finance and social responsibility into what we call the Carta. The Carta is an organizational framework that aids in both scaling efficiently and quick integration of future acquisitions. So Spire, which was acquired in November and is now Kin + Carta, trading as Kin + Carta America's West, has been integrated using the Carta, and it's growing ahead of plan, leveraging both our operational services and our growth engine in their expansion. Our M&A pipeline is active and growing, as founder-led, fast-growing consultancies in particular are very attracted, I should say, to the Kin + Carta connective model. I'd now like to hand it over to my colleague, Chris Kutzer, for a financial update.
Thanks, Jay. I'm going to start my financial update with a look at our revenue resilience and predictability. This slide demonstrates the underlying client relationships that drive long-term, durable revenue streams and value creation. The graph on the left reflects concentration of client spend and shows our top 30 clients now make up almost 70% of our revenue. The middle chart reflects client longevity and shows over half of our top 100 clients have been with us 4 years or more. So despite the pandemic's short-term impacts, it's clear that our clients recognize the continuing need for our services. The chart on the right reflects revenue predictability and shows that 2/3 of our revenue is derived from clients that have been with us for 3 years or more. The longevity of our clients is key to our growth and is enabled by both one, cross-selling Advise, Create, Connect, and two, leading clients across different technology journeys that we offer. The next slide shows exactly how this happens. Our clients have many reasons to continue with us beyond the initial DX engagement. Our clients are by definition climbing the DX technology curve, and we help them move from one tech cycle to the next. This slide illustrates the 10-year journey of a very large, long-term financial services client of ours. The client chose Kin and Carta to help them adopt and implement several tech curves over the years that started with building their mobile channel. This was a multi-year $10 million project that led to the next DX journey, moving to the cloud. That work is a multi-year endeavor that we are in the middle of delivering now, and the client has hired us to deliver an entirely new and separate team for voice recognition and artificial intelligence. By providing cutting-edge DX work, we're well positioned to lead our clients on these multi-year, sometimes decade-long journeys that drive long-term value creation for our clients and, of course, Kin and Carta stakeholders. Our full year financial highlights include net revenue of £138 million, up 1% including Spire, which was acquired towards the end of H1. Net revenue in H2 was down 4% in total and down 15% organically to £66 million, due of course to the pandemic. Our net revenue continues to shift into Create, into US, and into our targeted sector focus areas. Create continues to lead the way with 8% net revenue growth compared to last year and now comprises 65% of our total net revenue at £89 million. Create revenue has grown at double-digit CAGR over the multi-year transformation we've been through. And although it was temporarily disrupted by the impacts of COVID-19, we expect the double-digit growth rate to resume in the new fiscal year. Advise was launched mid-year as part of the rebranding of our propositions to Advise, Create, and Connect. Advise earned £2 million in net revenue on the year, and the future measure of success for Advise will be the revenue driven from Advise into Create and Connect large project builds. Connect net revenue was down 18% to £21 million compared to last year due to a reset of focus on DX work that culminated with a significant restructuring in H1. This restructuring just before the pandemic hit served us well. Connect has a solid managed services business and improved operations that has seen this business stabilize amid the pandemic and into the new year. Our non-strategic ventures business is now separated from the core Advise, Create, Connect business since they are not pure DX focused. We divested one ventures business, Pragma, in August and are in active discussions to divest Hive in a solidly profitable transaction. The remaining ventures of Edit and Insight had net revenue of £25 million, down 10% versus last year, and have been assertively restructured during the year and are trading profitably. This next slide shows the culmination of our restructuring to pure DX, with net revenue now over 80% from strategic DX, Advise, Create, Connect. And 65% of our total net revenue comes from our fastest growing Create proposition. This has been quite a shift, but worth reminding everyone, as Jay pointed out earlier, our DX businesses have grown organically at 10% CAGR since 2016, and our Create pillar has grown organically 18% over that same period, including the COVID-impacted fiscal 2020. Turning to the income statement, we've broken out the change to net revenue and operating profit for our recent and pending ventures disposals. Having covered the top line already, I'll comment on profitability. Operating profit was £13.8 million with 10% operating margin and a PBT of £10.5 million. The lower margin and associated profit compared to last year were a result of the pandemic and the effects of the lockdown on specific clients in H2. Some of our clients reacted swiftly and unnaturally to slow or stop projects midstream. We absorbed the impact by keeping some of the affected projects moving with the help of government job-saving programs and working with our clients on some longer-term options paying back in fiscal 21. Additionally, as disclosed at interims, our H1 results included approximately £3 million of investments into our growth and proposition platforms, which reduced the H1 profitability. So despite the sharply lower net revenue in late H2 as a result of the pandemic, our H2 operating profit was slightly higher than H1 due to those H1 investments, as well as the assertive cost reductions, restructuring, and focus on efficiencies in H2 that we took, and the timing of the Spire acquisition in predominantly H2 with its associated profitability. Adjusting items are higher due primarily to the Spire acquisition, a ventures impairment, and related restructuring, and the next slide breaks out those items further. Our earnings per share of 5.2p is lower than last year as a result of the lower earnings, partially offset by the Spire net accretive earnings. And note the Spire placing was for 15.3 million shares at 89p. Our adjusted effective tax rate was 19%, and we expect this to increase to 21% in fiscal 21, as a higher proportion of group income is derived from the US, which has higher statutory tax rates, taking into account federal and state tax rates. In response to the uncertainty caused by the pandemic, we withdrew the planned interim dividend and year-end dividend. We will revisit the dividend policy when market conditions are less constrained by the virus. Let me talk you through the adjusting item schedule. Of the 44 million pounds of adjusting items, 18.8 million is related to non-cash impairments of goodwill and trademarks, almost entirely in our ventures business Edit. 6.6 million is related to restructuring, including ventures, and the completion of the Connect restructuring in H1 mentioned earlier, as well as permanently empty property costs. 17.4 million pounds of adjusting items is related to acquisitions, with the majority from Spire. These charges are normal course accounting treatments of amortization and contingent consideration. The vast majority of our restructuring is now complete, as each business, including ventures, has been right-sized and is fit for purpose. Turning to cash flow. Adjusted EBITDA was 20.9 million pounds, including approximately 4.8 million pounds of favorable IFRS 16 effects. Adjusting operating cash flow was 24.1 million pounds, and this included 11.2 million of working capital improvements as a result of lower receivables balances during H2 and favorable DSO, moving from 61 to 54 days. CapEx was 1.1 million pounds, reflecting a reduced investment level in H2. Acquisition-related costs were 19.3 million, partially offset by 13.2 million pounds of the share placement related to Spire. Pension deficit and trustees' cost contributions were 2.2 million pounds, as we halted contributions with agreement from the pension trustee during the summer lockdown period. We have since reached agreement with trustees as part of our triennial valuation process. And finally, the net cash inflow for the year was 4.8 million pounds. Moving to the balance sheet, let me first highlight the IFRS 16 effects here, which were the inclusion of 14.5 million pounds of fixed assets and finance lease payable of 19.8 million at the end of the year. Goodwill and intangibles are 21 million pounds lower versus 2019, due primarily to the impairment of goodwill related to Edit and Pragma. The goodwill and intangibles arising from Spire acquisition were offset by the amortization and reclassification of Hive to discontinued operations. Looking ahead, the risk of further impairment has significantly decreased, as 94% of goodwill and intangibles now relates to our core businesses of Create and Connect, with the majority in Create. Working capital was lower, as mentioned, with the reduction in revenue and the improvement in DSO. And despite the pandemic, our blue chip and solid client base means we've had no significant bad debt concerns. The legacy DB pension remains in an accounting surplus of 1.1 million pounds and is 94% funded on a technical provisions measure. Net debt, excluding finance leases, is now at 31.6 million pounds, an improvement of 6.8 million compared to last year. As a reminder, our committed bank facility provides 85 million pounds of capacity. My previously stated target for net debt to adjusted EBITDA ratio was to be under 2 times, and the year-end ratio was 1.8 times. Our banks are excluding from the net debt calculation the US government Paycheck Protection Program, which is expected to be forgiven in the next 90 days. Therefore, the bank measure of net debt to adjusted EBITDA is 1.5 times, and this is against the extended covenant limit of 4 times for this quarter end. This extended covenant, which goes up to 5 times in Q2 and Q3, was granted in the very early days at the beginning of the pandemic. I expect our bank covenant ratio to remain below 2 times for the remainder of fiscal year 21. And finally, the Spire deferred consideration required to be settled in cash is 4.7 million pounds, of which 3 million will be deferred until February of 23. And I am confident that our balance sheet is in solid shape for the road ahead. In summary, we've made considerable investments over the past 2 years restructuring the business. The heavy lifting is now over, and our integrated technology consultancy platform is in place. Our revenue has proved to be dependable, as clients have concluded that staying ahead in the digital world is a business necessity. The strengthening of our pipeline gives me further confidence in our ability to resume growth. Our balance sheet is robust, and the headroom in our RCF is more than adequate. While the accelerating lockdowns around the world and the US election make for some uncertainty, I believe we are as well placed as we can be to move the business forward in these uncertain times. I've been with Kin & Carta for 18 months now, and I think the business is in better shape and better positioned to succeed than it has ever been. So thank you, and I'll hand it back to Jay.
Thank you, Chris. Chris has been a steady pair of hands for us this past year, and I'm grateful to have him as a brother in arms as we return this company to growth. So if you recall from one of our first slides, there were 5 things that the pure play DX providers all had in common. And we've translated these into our strategic themes for fiscal year 21 and beyond. And all of these themes are what's going to underpin our ability to scale, both organically and inorganically. So our DX focus is evident in our propositions and the core pillars of our business, and we'll continue to enhance these over time. A big focus for us right now is continuing to evolve our data transformation proposition, as we believe this has the fastest near-term growth potential. Our Carta will continue to be enhanced as well, with a near-term focus on operational efficiency as we drive to increase our margins as we continue to scale. We'll also continue to invest in our partnerships with a near-term focus on Google and Microsoft clouds, as we're seeing great traction from both of these software behemoths. And we'll continue to invest in those channels. And finally, we'll look to expand our reach with additional delivery centers in South America and Eastern Europe, as we also look to unlock new markets in the US through both organic and inorganic expansion. We don't have a ton of time, unfortunately, to spend on social responsibility initiatives today. And in many environments, under the pressure from COVID, a lot of companies may have pulled back on their CSR initiatives. We didn't. Some of our accomplishments are listed here, but one thing I did want to mention is that our B Corp certification, which independently certifies us as a socially responsible business, is imminent for our Americas and for our US and Argentina regions, and it's also on track for Europe for the first half of next year. And on top of just being the right thing to do, being B Corp certified is a powerful talent attractor and a differentiator to our clients, and that's going to be very helpful to us as we scale. So in summary, the pandemic has emphasized that it's no longer optional for businesses to become digital. We are on track for a V-shaped recovery as we had hoped. We expect Q1 revenue of our new financial year to be higher than Q4 of FY20, and we're well positioned to capture growth with the current pipeline at the highest level in 12 months. There is a time lag in converting pipeline to revenue as we scale up teams on these different accounts. So we expect our first half revenue to be slightly below last year's second half, but we're optimistic of a return to growth in the second half of our new financial year while remaining cautious on the continued macro uncertainty caused by the pandemic. Thank you for listening today, and I look forward to hearing your questions.